Hi, I'm Jimmy. In this video, we're going to look at dividend reinvestment plans. What is a dividend reinvestment plan? Are they good to use, or really, when are they good to use? And then we're going to walk through some examples of how they could be used, and I'm going to share with you how I'm personally using dividend reinvestment plans. Okay, so let's jump right in. So the simplest definition is when a shareholder gets paid a dividend, so we buy shares in a stock, they pay us a dividend, our brokerage account automatically takes that cash we receive from the dividend and buys more shares. The advantage of this is many times we don't get charged any commission fees, even though a lot of brokerage accounts don't charge commission fees in general, but usually it doesn't happen with dividend reinvestment plans. And you can buy fractional shares. So you don't have to buy one share at a time. You could just buy a small piece of a share. And just to show how powerful this whole process can really be, we're going to use AT&T as our actual example. So this is a chart of AT&T's dividend on an annual basis going back the past 11 years. And we can see that during 2020, AT&T paid more than $2 per share in dividends. So let's imagine that we had bought 100 shares of AT&T stock a few years back. Well, every year, as that stock kicks out a dividend, well, we gradually end up with more and more shares using a dividend reinvestment plan. So just to illustrate, let's imagine we bought our 100 shares about 10 years ago at the start of 2011. And at that time, AT&T stock was trading for $29.67. That was at the start of 2011. Okay, now let's switch over this chart to quarterly dividends, since this happens as the company pays out dividends and AT&T happens to pay theirs quarterly. So our 100 shares cost us $2,967. Well, the first dividend that we're eligible to receive was paid in February of 2011, and we received 43 cents per share at that time. And since we own 100 shares, well, that means we receive $43 in dividends. That happens on the dividend pay date. And on that date, the date that we received the dividend, well, AT&T stock was trading at $27.87, which means our $43 that we just received in dividends, well, that means it can buy us 1.54 shares of AT&T stock. So just like that, we now have 101.54 shares, and we just keep reinvesting that dividend automatically through the dividend reinvestment plan every quarter through the present quarter. And as of February 2021, which was the most recent dividend payment, well, we had about 177 and a half shares coming out of that dividend. Now, this brings us to something interesting, one of the interesting benefits of using dividend reinvestment plans. First, the advantage of a dividend reinvestment plan, or one advantage, is that it all happens automatically. It's not something we have to think about. So in our example, after we spent, let's say, about $3,000 back in 2011, well, we sign up for the dividend reinvestment plan with our broker, and then we fast forward to 10 years. We don't have to look at it. This will all take care of itself. And during that time, well, we almost double the amount of shares that we started with. And we can also keep in the back of our minds that in the case of AT&T, well, the dividend amount that they paid went up every year. So like I mentioned before, the first dividend back in 2011 paid us 43 cents per share. The most recent dividend paid us 52 cents per share, and we own a lot more shares. So on the next dividend with our current share amount, well, we would receive about $92 in dividends. And that's just for this quarter. If we were to count that dividend and the previous 3 quarters on top of that, so one total year, well, we would have received about $360 in dividends over the past 12 months. And when we consider the fact that we paid about just short of $3,000 on our initial 100 shares, well, this means that they call it a dividend yield on cost. Basically, how much you're receiving in dividends based on your original cost. In our case, it would be about 12%. Which is obviously a very good dividend yield. And that's not even taken into account that the fact that 177 shares or so are worth about $30 a share today. This means that the total value of all of our shares are about $5,300. So not only is our dividend amount greater on a quarterly basis, but the overall value of the portfolio is bigger as well, at least in the case of AT&T. That's not true with every stock. Of course, it depends from stock to stock, but this is the general concept. Okay, so with that as the baseline, I'm sure many of us can see the advantage of using dividend reinvestment plans. Now, many people live off the dividends that they receive at some point in their lives, usually later in life during retirement, either completely or at least partially off those dividends. And if that's our intention, before that happens, I think it makes a ton of sense to put back anything and everything we can back into our dividend stocks. Use the dividend reinvestment plan to spur the power of compounding. And this is sort of the definition of the power of compounding, or the power of compound interest. And that's when we take interest that we earn, in this case, dividends, and we reinvest that interest or dividends back into the stock, and that reinvested capital earns more interest or dividends for us. That is how our dividend, the amount of shares that we own, can just keep growing. It just keeps snowballing, assuming, of course, that the company is a good one and it takes the time to increase their dividends and hopefully grow their overall business. And as long as we don't need the capital, well, I think it makes tons of sense to just keep doing this for as long as possible. Keep using the power of compounding, because the moment we stop using the dividend reinvestment plan and we start spending those dividends, well, this stops. We end up if we did that through the entire 10 years, we still just have 100 shares. And this brings us to the flip side of what happens if we don't use a dividend reinvestment plan. And by the way, not all stocks are eligible for dividend reinvestment plans. Not all dividend stocks. Of course, they have to pay a dividend to be eligible, but not all stocks, not all companies sign up for it. So talk to your broker about whether or not a company is eligible, but most of them are. Okay, either way, what happens if we don't sign up for the DRIP? Well, first, we can take the cash that we receive and perhaps we can spend it on life expenses. This, again, like I said, makes sense once we need that cash. Many investors use a dividend reinvestment plan in something like a 401k account, where they gradually use a dividend reinvestment plan to build up their account, and then when they retire, they start taking out the dividends. By the way, it's also possible that we don't do a complete dividend reinvestment plan. You can tell your broker, hey, I just want to do partial dividend reinvestment plan. Maybe you only take out half and you reinvest the other half. So there's lots of ways to slice it. So if we're doing that for retirement, well, that's a great way to do it. But there is another scenario that I actually personally found myself in just recently. I got a comment on a video and somebody brought this up. That's what spurred the thought of this video is, does a dividend reinvestment plan make sense if we're trying to identify and buy value stocks? So just two quick examples. I personally own shares of both Disney and Intel. And I bought both of those companies when I thought that company was undervalued. In fact, that was one of the key reasons why I bought the companies when I did. I did research on both companies and I said, hey, these look like really good companies, but I want to buy them down here at this price. Then we waited for it to fall to get there. I did videos on both of those if you're curious. I'll leave links in the description below to those videos. But either way, for Disney, I paid a bit less than $100 per share. And for Intel, I paid about $45 and change per share for every share of Intel. And at that time, I felt that those were good buys and they could do very well over the long run. Well, fast forward to today, and it's been about a year since I bought Disney and about 6 months or so since I bought Intel. Well, as of just recently, just the other day when I was pulling down these quotes, well, Disney was trading at about $188 per share, and Intel was up near $65 per share. So from an investment standpoint, well, I loved Disney below $100 per share. And for Intel at 45, I was fairly confident with it. I thought it was a reasonable shot to take. And given where these stocks are trading now, well, I don't think these stocks are good buys at the current level. Now, Disney used to pay a dividend before COVID happened, and they actually paused their dividend during the coronavirus, but I'm sure it's going to come back at some point. That's why I'm including them in the dividend example. I fully expect they used to pay a dividend twice a year, and I fully expect them to reinstate that in time. I'm not sure when, but in time. But if you look it up right now, they have in fact paused their dividend. So the question is, with these investments, does it, as they kick out dividends, Intel on a quarterly basis and Disney when they eventually do it again, well, does it make sense to reinvest that cash we receive at this price? Or are we better off sitting on that cash and waiting to find another investment that we think is a good buy today? And once we find a great investment that we think is good today, well, we take all the cash, additional cash we've added to the account, and the dividends we've received, and we move it into the new investment. So this is why, personally, I have canceled my dividend reinvestment plans as of now. Now, I am actively looking for new investments, but if I was doing something like, let's say, dollar cost averaging even into an ETF every week, month, quarter, year, whatever it is, if I was doing dollar cost averaging and not actively looking for new investments, well, I would do a dividend reinvestment plan no matter what. Just keep it there. In fact, when I started buying stocks, I automatically signed up for a dividend reinvestment plan, frankly, just out of habit. Only in pausing to think, does it make more sense to take the cash that we're receiving and buy stocks at a good price instead of buying shares of Disney up at 187, almost double where we originally bought it? So given the fact that I'm actively looking for new investments, for me, I think it makes more sense to avoid the dividend reinvestment plan. Now, one other point that I just want to bring out, I didn't account in all my calculations if we look at this AT&T chart, well, in all my calculations here, I did not account for taxes, even though, yes, in many cases, we will be taxed on it, even if we reinvested. So if you sign up for a dividend reinvestment plan, that dividend income is still going to count, assuming you get taxed for it, depending on a lot of factors. Now, with that being said, just real quick, switching over to AT&T's price stock chart. Well, this is a chart over the past 10 years. And what's interesting about this from an investment standpoint is if we look at where we would have started, this chart starts on the day we would have bought these shares. So I believe it was January 3rd of 2011. And we can see that over this entire time period, from a price perspective, the stock is only up about 2 or 3%. Now, yes, if we had reinvested our dividends back through this entire time period, well, we would be up slightly more than 80% since then. So clearly, that's a huge difference. And if you're curious why a stock like AT&T, which pays a relatively high dividend, would be so flat over such a long period of time, 2 or 3% price move over 10 years is a very, very small move. Well, if you're curious, that actually has to do with how dividends actually work and how they affect the stock price. So if you like dividends and want to learn more about how dividends move, I actually did a video on the effect, the truth behind dividends, the effect of dividends on the stock. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.